Hi everyone, Rich Sassman here with Century 21 Affiliate. Scott Swinford here, Hancock Mortgage. It's another Mortgage Monday.
It is. It's a good Monday.
It's great. It was always a great Monday.
It's especially when it's 50-some degrees out and the snow's melting, and it's always good.
Springtime is getting close. So, how was your weekend?
We're getting there. It was way too short as
Way
usual.
too short. Usually.
A lot going on morning, and drove to Kalamazoo yesterday. Back at it since a little after 7 o'clock this morning.
A bunch of houses in Chesterton. And I think we found a winner. So, I'll get going and get them into their dream home.
Good.
Chester. Oh, it's beautiful. So,
and they got a brewery up there too, the Chesterton Brewery.
Hey, look at that.
Slug.
Shameless plug.
Burn.
He's trying to get a free beer. Look at that. So, thank everybody for joining and tagging your friends in this video. I appreciate it. We're going to have done in a while and talk about what exactly is. So, and a mortgage is from the mortgage guy.
Mortgage is actually a financial instrument that you sign at the closing. We often use the word applying for a mortgage or getting a mortgage guy. Technically, what is a loan officer who prepares all the paperwork and everything for them, for the title company and the attorneys to draw up the mortgage, which is the financial document that says you will pay back the money that you loaned to purchase a home.
Yep. Or pay it back, then they get to take your house.
Exactly. So the mortgage is a financial instrument. The mortgage note, the other things that you sign, but that's essentially what it is.
Yeah. Your house is your collateral for saying that you're good for the money, basically.
Yes, and exactly what they do is they use it for collateral. When you deed the property, you'll see what it's in your name, as well as the mortgage company. It's usually there's something called a mortgagee clause that it's to the name company and or assigns, and so if something happens, your house burns to the ground, unfortunately, they don't send you a $200,000 check off to Mexico and then leave a pile of rubble. There's no collateral for whoever the lender was that made the loan for you.
Yep. So, just think about it if you were the one loaning out the money for somebody to buy a house. Right? So, and that's basically what they're trying to do. They're trying to make sure that one way or another, you're going to make sure you get your money back. So, but in order to do that, either Scott or myself, and we'll get you pre-approval going. So, I talked about this in the past few videos, and it's just a very important step because the beginning process, you can't put in an offer, have it accepted without one usually, and it's very. It's not. It costs you nothing. It has tons of value, but it costs you nothing. So that's a pretty good deal. And
it's pretty easy to do. An application that is entirely internet-based or web-based. It starts out with really hard. You have to choose one, like purchase or refinance. You click purchase, and you answer a few questions, and it takes. I think the record that I've seen is it took me about 4 minutes to get it back to me, filled out after I sent it to him. I had a lady who was, I believe, in her 70s who said she's not computer literate. She doesn't know how to use her phone. I said, well, give it a shot. If not, I can help you. And within about 12 minutes, I got back, and it was fully completed. So it's pretty easy to do, but it gives us the ability to look at your debt-to-income ratios that you have given, income that you've given us, what you provided for us there. But it's also the authorization to pull your credit report. So we'll take a look at the credit report, see what's on there, make sure your scores look okay, and then move forward from there. So it's not a real difficult process. It's not a long process. It's a necessary process.
Yes. So, and it tells any seller of a home that you are a serious buyer and you're gonna be a great person in this contract with them. So, knowing that you're financially sound. So,
Well, and put yourself in the seller's position. Though. If Rich came up to me and said, "Hey, I've got dollars for it," and I say, "Great, so show me some proof. Make me feel all warm and fuzzy now that they are going to be able to go through with the loan. This is actually going to close." If you're asking me to take my house off the market for 3 weeks, 4 weeks, 6 weeks, whatever that amount of time happens to be, and especially if I have found a house now that I like, and my intention is to know that the person who is making the offer on my house is in a good financial, I would absolutely ask for a pre-approval from who entrusted, so that I would have a reasonably good idea that what this was going to be. We're going to be able to close on my home, and then I could close on my new one.
So, and there's loans. There's no loan, the FHA loan, there's VA loans. Those are the big three. There's other ones mixed in, but those are ones that you're really worried about to begin with.
Yeah. We've got USDA here. I think we talked about it before. We can't do a USDA loan where we are sitting right now.
No.
If we go just a little bit south of Lakes of Four Seasons on the Porter County side, all the way down to just a little east of Lafayette, that is all USDA area.
Yes.
So it's 100% financing. USDA is it's a pretty vanilla type loan, fairly low income ratios, pretty conservative underwriting guidelines and things, but it's 100% financing.
Exactly. And when it comes to the big three loan products that are out there, now let's look at it from the side of we're looking to accept offers between conventional FHA and VA. They all close in pretty much the same time frame. There's not a big disparity between them, and so that alone doesn't disqualify one loan from another in my book, because they all paid at closing, which is good if you're the seller. If they're all the same time frame, that doesn't really. So then you got to dig a little bit deeper and make sure that the contracts, which one's the best contract for my clients as the sellers. So if you're worried that you have to do FHA over a conventional loan, when it comes to, it's about the same amount of time, and sellers get paid at closing just like the other ones. So.
Because I hear a lot of things from agents that say that they don't want to
Bring
take
that
VA loans because they're 100% financed and buyer has no skin in the game. What are your thoughts?
I've heard that even though this has no meaning whatsoever to sellers, they have the lowest risk of defaulting, which means nothing because the sellers already got paid. They
Sooner.
if not sooner, their inspection period. I mean, their appraisal period.
The appraiser has 5 days in Indiana to return the appraisal once they've accepted it. Now there are, there's times where that will vary a little bit. I've had it come back too, but I can tell you that, in all honesty, and if you know me, if we've talked before, you know that I'm a huge proponent of the VA loan program.
Yep.
Oftentimes we can close them a little bit sooner than we can other loan programs, just because of the time and thing. But our VA buyers are, on average, better credit scores, more money in the bank, greater income than our FHA, most of our conventional buyers. So the fact that the veteran borrowers can get 100% financing is because they signed their name on that dotted line, what they would give up to and everything, including their life, for our country.
They put other type of collateral down.
but about exactly. They literally put their backside on the line. Down payment, they put
Yep.
money down. So it's not what they don't do it; it's just they have the ability to not do it if they choose.
Exactly.
And we've talked a little bit before about the difference in your down payment, things like that. So if somebody came in and said, "Well, I want to put an extra $10,000 lower my payment," in reality, that is probably going to lower your payment by about $50 to $60 a month. But furniture and paint and others for $10,000, but you wouldn't have to put on a higher interest card.
Exactly. So so let's talk about some of the similarities and things that set apart. Since majority of people will either not VA, but FHA and conventional loan. Let's talk. One of the biggest costs in your monthly payment, that one it drops off and the other one it stays on for the life of the loan, and that is my private mortgage insurance.
That's a monthly payment, and depending upon how much you put down, usually the folks who are grading towards the FHA number one, put down. They're not the 10% or 15% down borrowers. Sometimes we'll see unconventional, and we just talk about that with the VA too. I don't think it makes a lot of sense to put down huge payments because it really doesn't change your payment, your monthly payment that much, and there's other things to do with it. But so the FHA, a little more lenient on credit scores, a little more lenient on debt to income ratios, and have a mortgage insurance premium that is not only paid upfront, but then you also have a monthly premium too. So the upfront is included in the loan, so you're actually borrowing that part, and then you have a monthly mortgage payment too.
Yeah, and so you'll pay it until you get to 20% equity in the home, and then your payments go down. But with an FHA loan, you would have to refinance out of that loan once you get the proper amount in the home. And in order to do that, a good starting place is to get a free market valuation. And I will, and they'll let you know. So if you bought your house 3 to 5, your house has appreciated quite a bit in Northwest Indiana, likely, and you could refinance out and some lower payments. I mean, if you're talking about $100-$200 a month, depending on what you put down, I mean, what can you do with $1,200 that you don't have to spend on that? Pay down other debt, go on a small little vacation. There's a lot that you could do with that $1,200.
Right.
That just giving it.
So they're giving it to your lender, right?
Yeah.
And it's part of a long-term financial goal and financial planning. Rates right now have been exceptionally low.
Yes.
The reason for that has a lot to do with coronavirus, because everybody was panicking. The stock market was having a sell-off, and stock bonds have kind of that other issue. So when the stock market's doing really well, people make a lot of money in the stock market, but there's a lot more risk. So they take money in bonds, have a little more interest to get people to come in there, but they're safe.
Yeah.
Now with the bond funds, which have that safety, now with stocks are to scare people off, more people are putting money in bonds. They have to pay as much as high as interest rate. And when you talk the Fannie Mae 30-year bond fund, which these two do not run in lock sync, but it's a good idea. Most of them, most of the time, they go up or down together. So we've seen some really good interest rates, but rate alone is not necessarily the reason to refinance. Nope. Again, and we do a horrible job. And I'll be honest, when I look you right in your eye and say, I probably deceived you, is we always posted something the other day said interest rates are extremely low. Now is a great time to refinance. Well, it's true. It really is. But
what was an answer?
It's not just exactly, but there are, as part of your long-term financial goal, if you take out funds or lower your monthly payment, that's really what you're.
Yep.
So even if you have an FHA loan currently, which you're paying 4% on, and you have a conventional loan that you're paying 4% on, if you can out that or get rid of the mortgage insurance, you're going to save X number of dollars a month by doing that, even at the same interest rate. But the biggest we see, and especially now that a lot of our clients are developing equity in their homes, is that they can pull out some of that equity and pay off some of the higher interest rate credit cards and auto loans and things like that. So now if you can, even if you refinance, if you've had it for 5 years, you've got 25 years left on your loan, take out a 30-year schedule, you can always pay more on your mortgage.
Yep.
Take out a 30-year mortgage, pay off those credit cards, pay off those other things, and if it saved you, take some of that now and put it back into your mortgage. And not only will you'll have lower monthly debt by doing that. It just takes a little bit of planning.
Yeah, and not to mention, one thing people don't realize, the interest is front-loaded on mortgages, too. If you're paying more principal down, you're going to be, up front, you're going to be paying a lot less interest from that debt.
And that's a huge, Rich, and that's really good. If you owe $100,000 and you're, let's say, for instance, using round numbers, you're paying $1,000. Of that, very much, $90, $100 maybe is going towards principal.
At first.
So the first month. So the next month, you're paying interest on $99,990. Okay? If you notice each month you're looking at an amortization schedule, you pay just a little bit more towards principal, a little bit less towards that interest on there. And it takes you about year 21 is where you're 50-50, where half of your payment goes to principal. The
Isn't that insane?
Goes to your interest. However, if you pay an extra $200, let's say first month, now your payment on the second month, you're only paying interest on $99,900 or $700 rather. So now you pay less interest on that, but of that payment, more goes towards principal. And when you keep doing that, it's kind of like a stone rolling downhill.
Yep, and that they give you a schedule of how much principal you're paying and everything, and closing and all that stuff. As soon as you pay $1 more than that mortgage payment, guess what? That entire schedule goes out the door. It changes. So,
and there's things that we can do. We talk about too. I have a lot of clients say, "Well, good to do half payments every 2 weeks." I had a company that told me we could do this. The other way to do is if you get paid every 2 weeks, you're getting paid every 28 days. So if you make your mortgage payment out of every other paycheck, then you're essentially paying it every 28 days. And what will happen is you'll make 13 payments in a year, just because of the way that works out. Well, if you make one extra payment a year, of payments on there.
wow.
By one extra payment a year, you'll get it down to between 24 and 26 years. So, and it's not really that different. And again, you're not making the payment every 28 days or every other payday. So tricks out there to kind of show you how to help you get the, but get a lot of that. If you've got a credit card, interest rate, auto loan, those first.
If it's your only debt, then you can start doing that. That's no problem. But make all your other debts gone. Like, student loan debt, that sticks with you forever. So that's always to get rid of if you don't have any other debt.
Oh my God! Speaking of that, I saw a post the other day.
That just get a box out for you here.
Oh, this is going. Wow. So, couple other lenders were showing. They were talking about the largest amount of loans that they've seen on a credit report, and one screen. They have a bar. I want to say $850,000 in student.
Whew.
and they're in deferment.
And just pay.
But the interest is increasing.
Yeah. Oh.
The current balance is 1.035 million. They have another one now who is student. Their current student loan debt is $3,000 a month. So $36 a year. They make $80,000 a year. How's that possible to live on?
It's pretty impossible to live off of, but
Think about that. So your home debt. So these are things that, I mean, I took out a couple loans for my son too. And every month when I look at it, I'm like, are you serious? It went up how much? Because they're in school. And if they're in deferral, then they're going to continue to build interest. So I make a payment on them here and there. I mean, understand this is a debt that we need to take probably seriously, if not more seriously than our loans and credit cards.
Yep. And as soon as you free up one debt, pay off another type of debt, and figure out which one for you, and figure out and just get it gone, because it's insane. They're like a they're it seems like they'll never go away, but
they grow on you.
Literally they grow on you.
But one because we're almost 22 minutes into this.
That was an easy 22 minutes.
Probably one of the longer ones.
Yep.
Yeah. Is I'll preface it with this, and this is not for everybody. You really should have some sort of debt on your report, or at least something like a credit card where you borrow money and pay it back on time. You don't ever have to or carry a payment and pay interest on it, but at least borrow money and pay it back on time. There's that group of folks who say, hey, if I can pay cash for it, I don't need it, so I'm not going to buy it, or they purchase ours with cash, or they don't use credit cards, things like that. I have a couple of young ladies who are looking to buy homes, and they're exactly that way. I'm sure that's the way they were raised. Their parents on their credit report.
And there's nothing wrong with that. That's a great way to live. That keeps you out of trouble. But
the problem is when you say, hey, I want to buy a house, and we say, great, well, show us what your documented ability to borrow money and pay it back on time is. There is none.
Yep.
For these two. So,
it's as simple. Go charge a pack of gum.
Yeah, they have nothing.
Yeah.
Zero. Zilch.
So.
And we can work with that, thankfully. So we can work with that. We can use non-traditional lines of credit. It's just a little bit tougher. So I guess my advice to you is, folks, for everything, that's awesome. Two, if you're gonna pay cash, take a gas, charge it, and then when the bill comes off, that's all. You're paying cash for it, but you are now documenting the ability to borrow money and pay it back on time for a long time, and that's really what they like to see, and that's how you get good scores.
Yep. And so feel free to do that. If you have any questions about any today, please feel free to give us a call or message us. If you know somebody that can benefit from this, please share this with them. It would mean the world to us. If you're watching us on Facebook, please comment on here and tell us where you live right now. That way we know where everybody's tuning in from. Other than that, that's Scott Swinford with Hancock Mortgage Assessment with and about another Mortgage Tip Monday. See you guys next week.
Okay, folks, enjoy.